Hello, folks. This is a part two, continuing with yesterday's part one. We have a lot to cover, so let's get to it. We have a total of 15 slides. Um, so here, this is a leftover slide from yesterday. Really should be part one, but I'm just to quickly give you a highlight. According to NASRA, National Association of State Retirement Administrators, only 25% to 24% of the contribution for retirement benefit is from the employees. Okay, the other 76% is from employers. So you can clearly see that for every dollar that is contributed by the employees, $3 will be contributed by the employers. So there's just something that to keep in mind. Um, and then here, this is where we come to the biggest issues, that unfunded liability. This is what makes people worried, concerned when they hear the word unfunded liability. They said, okay, oh my God, am my pension benefit covered? Would there be real money waiting for me when I retire? That's what makes people worried. The other thing, before we go to the unfunded liability, let's look at this word, the pension cost. Usually you will see that the pension benefit, right? But this pension cost is the same thing. It's a different size of the same coins. So for the employees to get the pension benefit, somebody has to pay it. So that payment will become the cost. That will be basically employer's cost. Okay. So just from now on, when you hear the word pension cost, pension benefit, just bear in mind that pension benefit is looking from the employee's benefit of employee's perspective. Pension cost is looking from employer's perspective. They are the same thing. Okay. Unfunded liability, this is the big issues, okay? So basically, the definition is easy, just like I said before, it's a projected gap. Remember, it is a projected, meaning that the gap is in the future, not today. And then the gap between what? The gap between the pension benefit to be paid and the pension asset that to set aside to pay that money. So if if the liability and asset do not match, then we have a gap. And that's what we call the unfunded pension liability. Um, Here we can talk about the normal cost and talk about the normal cost and then catch-up cost. Okay. So if there's let's look at this scenario when there's the amount of asset is smaller than the amount of liability, then we have unfunded liability. So that means in this case, we will have for each year we will have a normal cost that normally you have to pay. We'll come to the normal cost later, and then also you have to catch up whatever is left over from the previous years or previous decade, it has to be paid for. So when you have an unfunded liability, the picture is not good because you have a leftover liability, and then you also have a current liability, which is a normal cost. Current liability means your normal cost to cover the normal, cover the current liability. The second part is the leftover liability. Okay, but if you in such a situation, a good situation where the pension plan's asset is equal or even more than pension plan's liability, then you have a very nice situation. Then you only worry about the normal cost, and then you don't need to worry about the catch up leftover liabilities. So let's look at the big picture. How big is the unfunded pension liability? Or you can call it liability, or you can call it the fund shortfall. The variation, the estimation varies a little, big, but not little, but big. According to urban.org, it's a non-profit organization, obviously. the estimation can go from $1 trillion to $4 trillion. That's a lot. $1 trillion, $1 trillion is equal to $1,000 billion. $1 billion is equal to $1,000 million. So you can see that the figures are phenomenal, astronomical. Okay. And then why is such a big difference? When it's basically between 1 trillion and 4 trillion, that's like a 3 trillion difference, $3 trillion difference. Why is such a big difference? The simple answer is that we use a different discount rate. Okay, so if you different discount rate is used, then you get the different number of estimation. If you use some favorite discount rate, then you only got $1 trillion for unfunded liability. If you use that non-favorable discount rate, then you get to the $4 trillion. Okay, so huge difference. So basically, economists were arguing that in order to use the appropriate discount rate, that discount rate must reflect riskiness. Okay, so why is that? The idea is the same. We all know that no risk, no gain. So if you uh, um, using different discount rate to reflect riskiness, meaning that you have to think of how big the risk is. If the risk is big, then discount rate should be bigger, should be big. If the risk is low, then discount rate should be low. So let's get into that. Here is a quick formulas. This FV means future value, and PV means present value, and then this is the formulas. Okay. And then so you basically, these two equations, you can easily transform into each other. If you move this part uh, for the for the future value, you basically multiply the present value with this term. And now in order to get this present value, you move this part into this left. And here on this first formula, it's multiply, but in the second formula, it's division. So let me give you a short story that the future value is most useful for the banks. They need to find out, if you are putting the money in the bank and in the savings account, they have to figure out, like in the future times, how much money they have to pay you. So that's what the future value it comes about. Okay, they're talking about the future, not today. On the other hand, the present value is that today you have to pay, right? So what the value of today? So, but the good news is that this future value and present value, they are interrelated. So all you need to do is that from calculating future value, you use the present value times this term. But if you want to get the present value here, and then all you need to do is use the future value and divide it by this term. So this term, the key issue is this one. Okay, this is called a discount rate or a rate of interest, the same thing. And then the time is just the time unit for or a number of a period. For example, if the interest rate is calculated monthly, then number of months. If the interest rate is calculated annually, then number of years. Okay, usually we use most frequently we use the number of years. Okay. So just to bear this in mind that this formula, the only thing to keep in mind is that this interest rate is also called a discount rate. It's the same thing, okay? Which means that the value will be increased by this much. Why? Because the bank will pay you this interest rate in order for you to keep your money into the bank. The same idea, okay? So knowing this formula and keep this discount rate or interest rate in mind. And now let's get to do this. This is a normal cost. Normal cost is very important. Remember I said that earlier, a couple slides earlier, I said that if the situation is such that your pension plans asset and the pension plan's liability are equal, then all you need to worry about is the normal cost. But otherwise, if your pension asset is smaller than liability, then you got a problem, right? So then you have to not only worry about the normal cost, but also you have to worry about the leftover liability, which means more money you have to put in, right? So here, the simplest normal cost is it can be pretty technical. In fact, we have quite a few formulas. I'm gonna write a book on this, and I'm gonna get into the technical details. But for our purposes, it's easy. We just think about figure out how much contribution we need. Okay, because we figured once the statisticians figure out what's the future benefit to be paid, then we have to find out how much money need to be contributed today. So in order to pay that future benefit, okay. So the easiest way to get the normal cost is use that as a percentage of the total salary earned by the employees in the pension system. So that's easy. Let me give you an example. Let's say the actuarial decided that in order to cover the future benefit to be paid to the employees when they retired, 13% of the salary need to be contributed, deposited, or set aside, or take away, and deposited for the contribution. And then for out of this 13%, you employees pay 6%, and the rest of 7% will be paid by the state government or city government. Obviously, this is not very generous because remember, uh, earlier we said in general, if you look at the nationwide, um, only 25% are paid by the employees, and 75% are paid by the employers. So then I'm just to give you an example to show that what is the normal cost is intuitively. And then we can say, here comes to the key issues that we're getting to debate. Everything is caused by AER paper, academic paper. AER stands for American Economics Review. It's a top journal in economics, and that they published the paper in May 2009, and that's the title: Discounting State and Local Pension Liabilities. The author, the Brown and the Wilcox. Okay, there's two guys. They are not the first one to raise the issue, but they're probably one of the most influential, because a lot of people are quoting this, and also this paper has a direct impact on the GASB rule. So we'll get into that pretty soon. But basically, their argument is that if you're talking about the defined benefit, remember defined benefit and defined contribution, we talked about it yesterday. Defined benefit refers to promised no negotiation, you have to pay, because if you say you pay the employee, the state employee, $500,000 when they retire, and then the employee can sue you if you don't pay them $500,000. So that's what a defined benefit. So basically, this economist says they raised the interesting issue, and it seems totally legitimate, saying that the defined benefit, the retirement benefit, it's protected by law. So because you're protected by law, so there's no risk, zero risk for the employees. So that's why we should use risk-free discount rate. Okay. And remember, I said that earlier when we look at the equations for present value and the future value, is that what the discount rate to use is the key issues. But here the economists are saying that because the employers, state employees, they are risk-free because their money is guaranteed. They have to receive the money, otherwise the state government, the local government will be violating the law. So because you are talking about a risk-free benefit, you should use the risk-free discount rate. So here's the issue: what is the risk-free? in practice, we're usually using 3 months maturity treasury bill rate. Here, just a quick note that the treasury bill is a three fixed income issued by a treasury department. The shortest one is a treasury bill, which means basically they will mature within a year. And the second one is a treasury note, which is within 10 years they will mature. And then finally, it's the treasury bond, which is mature probably like up to 30 years. So treasury bill is the shortest. They can mature 3 months. So basically, um, so this is commonly used as the risk-free discount rate. How much do you pay by uh, uh, treasury bill rate? Usually, I checked the other day. It's probably like a little bit over 4%. That's because we have high inflation, right? Um, so even for risk-free discount rate, it's 4%. But earlier, talking about the 2021. With the quantitative easing, the interest rate, the discount rate is very, very low, much lower than this. Okay. Now we are in inflation time. Okay, so now the economists are saying that if you, right now in practice, almost all the pension plans are using long-term assumed rate of return. And the economists say that's wrong. That's pathetic. Okay, for three reasons. Number one, you will make, but remember that the present value will be divided by 1 plus discount rate. So if you have a big discount rate, the present value will be much smaller. Why is that? Why the government, state and the local government want to have a smaller present value? Because then they don't have to contribute that much money for the future pension benefit. So that's why they say that you are you artificially make the present value of the liability too small to be real. So that's one criticism. The second criticism is that because you are assuming the long-term assumed rate of return, which is like 70%, 75, 8%. So you will encourage all the pension plans to invest in riskier asset classes. What is a riskier asset? Remember I said in the part one, stocks and hedge fund and then real estate and then private equities. All these asset classes, they are higher risky than the risk-free discount rate issued by the state, the Treasury Department. So if the all the plans, pension plans are looking for 7.5% or 8% of earnings, then they will obviously they will invest their money in order to realize that high rate of returns. They have to invest the money into stocks, into pension fund, into hedge funds, into private equities. That make the decision, the investment decision is riskier and cost maybe affected the retirees to get enough money for their retirement. So that's the second criticism. The third criticism is a little bit trickier, so let me explain that. They say that you will encourage the pension plans to turn themselves from investors into issuers. Issue what? There will be issue pension obligation bond, POB. Okay, why would this pension plan want to do that? Because there is a trick. If you are trying to assume the long-term interest rate of returns, 80%, right? So if you can get the investment from doing that, so that's you get a higher rate of return. However, there's if you issue POB, the bond. Just like Berkeley, city of Berkeley, they decided to issue bond and then for people to buy. So the role is different now. Instead of being an investor, you become an issuer, meaning you're just like Google, you're like Apple, you're like Facebook, all the companies, they become issuer, right? Because they issue their stock and have a initial public offering, IPO, and then people buy your stock or bond. But here, by issuing POB, the city government, the state government, they become issuers, not investors. Okay, so the reason they want to do that is that because they the issuer as an issuer their bond, they don't have to offer high interest rate. Why? Because they're considered risk free or low risk. Okay, so they let's say they only offer you like today they only offer you like 4% or 3.5%. Why? Because it's a city issued by Berkeley and issued by California, the fourth biggest economy in the world. Berkeley's economy is doing good, so you don't have to pay such a high interest to make people to buy it. Okay, so they can issue this POB and then pay like a 3.5%. Meanwhile, they can save some money. They can get like 8% or 7.5% from stock market, right? So the discount rate difference will be in favor. That's why the city government, the state government will have the incentive to issue POB. So according to the economist, that's also risky way of doing things because it may hurt the benefit of the public employees. But let me issue my four criticism. I think that there are four problems with the AER papers, American Economic Reviews. The first one that they ignore the most used remedy fund is from general revenue. So instead of since the economists saying instead of issuing POB, instead of using the other tricks, the most likely the state government, the city government, they will get the money from the general revenue. What is the general revenue? General revenue is from the taxes, okay, and tax people pay tax every year. So by getting money out of the general revenue, tax money, and to pay that the unfunded liability, uh, this is the people most likely doing that in real life. The economists that didn't mention that at all, which is misleading. Okay. And then economists, by making that above argument, they also penalize the diversity. Why do I say that? Because right now, remember in part one, if you look back, you can see that nowadays all the pension fund, the public pension fund, they are investing into a whole bunch of different asset classes, including from stocks and the bond and then private equities, real estate, and then even hedge fund. Okay, so by asking all the state, all the public pension plan to reduce to one single rate of return, which is risk-free, which is basically they did not ask the public pension plan to invest into treasury bill, but by using the term risk-free, basically that's the only thing that economist says that all the public pension plans should be investing into. So this is penalize the diversity, and you force all the pension plans into using one single rate, which is very low, right? And then there's another problem with that is that they also by penalize the diversity, they also depressing the multiplier effect. What is the multiplier effect? It means that if anybody has $1 and you start $1 in the market, and then that $1 will be used again and again and multiplier It's more than $1. For example, if you use $1 to buy a cigarette, and then that $1 will be used by the different people, for different purposes, and that's why money leads to money. That's what we call the multiplier effect. And this is according to SEC, Security Exchange Commission. There's one commissioner here. The speech, I think is a she, is a speech. She actually quantified this multiplier effect, meaning that the $1 you spent by the retirees, they spend every dollar they spend will translate into almost $2.50, $2.50. So that's another thing. That basically says that you should let people get the retirement money from any way possible, and then let that money multiply. Okay. And then finally, I guess the most important reason is that those economists that they ignored the embedded riskiness. So when they criticize the long-term investment returns, long-term investment rate of returns, they forgot that in the long-term investment, you have actually risk is already embedded. Okay, that's why we call it something called a beta. It's actually, when you think about this, okay, when you say the market is volatile, that volatility is actually part of a riskiness. So don't ever say that the long-term investment is no risk. Long-term investment has risk embedded. Okay, so don't forget that. Okay. Okay, now let's look at the GASB. GASB basically accepted the AER paper. And so in their rules of 67, 68, they offered something called a dual discount rate. What is a dual discount rate? They basically split the discount rate into two parts. So in the first ideal situation, function plans asset equal or bigger than liability, then you use the asset-based assumed long-term return rate, which basically, let's think about it for our purpose. Let's think about it as like this, at least 7.5%. Okay. However, in the less ideal, more open scenario, that was function plans asset is smaller than liability. Then they said that the GASB says you should use a liability-based municipal bond return, which basically, I checked it last time I checked yesterday, it's basically 3.6% at 10 years, 4.3 at 20 years, and 4.5 at the 30 years. Okay, that is today. Okay, imagine in 2021, it's probably close to zero. Okay, so the idea is that if your pension plan has not have enough asset compared to reliability, you must use a very low discount rate. The point is that to penalize that, you have to catch up. Otherwise, you end up uh, not producing very bad situations. Okay, let's criticize. Let me criticize the GASB problems, obviously related to AER problems. Number one argument is that the POB is rarely used. Remember, POB means pension obligation bond. That's rarely used. Why? Because um, the problem is that if your government decide to use the POB, then the POB will not be tax free. Okay, that happened in real life already. And Detroit, the city of Detroit was bankrupted. They tried to use the POB, but then Fed quickly jumped in. I don't remember. I think it's a Fed or either Fed or SEC to jump in and say, "Hey, that's not," or even Congress. They say POB is not tax free. Why? Because you're not. This is a that's the your city government or state government is supposed to not use POB. You're supposed to put the money down, save enough money to catch up the liability. So they take the tax-free part away. So that's lost a big incentive for people to buy POBs. Okay, so on top of that, the government, like I said, the government tend to use general revenues. Okay, so the problem with using general revenues, there's no discount because remember, general revenue, it's people, the government collect tax every year, so there's no discount. They come the money from the same year, okay, and then without this, without a discount in the present value, the present value will be equal to a future value. There's no discount because the money is from the same year, and then that means that the employee must contribute more, okay. So in a way, GASB rule basically actually helped state and city government to contribute less by asking them to have a municipal bond rate, okay, which is not the 0%, which is like today's is even 4%. But if you're using the real general revenue, the real the real discount rate should be zero, right? In that way, the gas fees actually helped um, the municipal government to contribute less, even though their intention is to ask them to contribute more. Okay, so so my basic argument is that you should not force municipal government to use that AA rated municipal bond rate. Only if they actually really issue the POB, pension obligation bond. Otherwise, you should not, there's no reason to charge that POB rate, charge that AA rated municipal bond rate. Okay. So otherwise, they are just the investors. They're not the issuers. The big difference for the investors, they they're just like us. They are institutional investors. They should be protected. They have a GASB has a duty to protect the institutional public pension investors. And then every investor should have the right to use long-term market rate of return. They should not be deprived of that right. Okay, doing that is wrong. Okay, and again, the public pension, they do not often use POB pension obligation bond because the number one, the first option is going to general revenue, like I said already. The second option is to fund using from active employees' contributions. Remember that the people who are still working, they don't need to get the money out. Meanwhile, they also contribute the money into that your pension plan. So that money can be useful to pay the current obligation or liability. And then the third option is that relying on an annuity installment. That's basically saying that for the majority of retirees, they just get their monthly payment each month instead of taking money out lump sum. If you take the money out lump sum, that may create more financial pressure for the state government, right? Because you take off $500,000 lump sum, and that'll create. Otherwise, you just for the annuity monthly payment, the financial pressure is much smaller. So again, the next ones are talking about the GASB has a duty which they should not have exercised. And then the other problem is that liability-based rate assumes POB issue. Again, this is the same thing. If you are asking all the state government or the city government to use the single rate of AA rated tax exempted municipal bond rate, that's against reality. Uh, and then, so we have so remember, I first listed a few options for the municipal government to deal with the unfunded liability. The number one is that they use general fund. Number two, they use the pay as you go, using the active employees' contributions to pay the benefit of retirees. Number three is that uh, most retirees are getting annuity monthly installment instead of taking out the money out of a lump sum. So basically, all the three options can be divided into two categories. They borrow from the market. When I say they borrow from market, that means POB, pension obligation bond, or they borrow from the internally from the general revenue, and then but it's both, both ways. Either you borrow from the market or borrow from internally. You have there's a cost associated with that. Okay. So my key idea is that first of all, the risk is embedded in long-term rate, even though that whenever you use a long-term rate, I guess the economists that they missed the point, the important point that when people are using, when the state and local government are using long-term rate of returns, they actually acknowledge the risk. They're not risk-free. Okay, the risk is already embedded. So that's my key point. Just because they are guaranteed to stakeholders the benefit does not mean the investors have control over rate of return. So remember, that's why I said that the investors and the issuers are very different. Investors totally depend on the market. They have no control over the market rate of return. But the issuers, however, if you are issuers, then you can artificially you can reach a agreement with the underwriter, say, hey, I'm gonna get a 10% from issuing the stock market. So they have more control for the rate of return. But otherwise, if the pension plan, just like you and I, they are just the investors, then market has a control, not them. So the best approach is basically not to borrow. Remember, I said either borrow from the market or borrow from internally. Borrowing is not good. The best way is to invest. That's why you should invest all the contributions and use the earnings to pay the pension benefit. Invest is much a better deal. Why? Because money leads to money. Money produces money. Okay. Um, so my key suggestion is that we should have an overfunding because there's a difference that between me and the other guys. There's one guy who's arguing that the overfunding is a better idea because it leads to opportunity cost. I have to say overfunding is good because you are putting money into the market, which is a known for has risk, but also return is excellent. So instead of using the general revenue money, which is no money doesn't lead to money, money doesn't produce money, it's a lousy way to do that. So let's do that overfunding and put the money into the market and get earnings, and then we can pay that. The key is that not over promising. Okay, the current system is basically says that it's an individualistic model. So for each individual employees, I said, I promise you whatever I got from the market, you get 100%. And that's not the right way to do that. We should take some money out of it. We should only guarantee them that your contribution and will invest into the financial market, but we only guarantee you like 2% of real returns. Okay, so anything above 2%, we'll take it and become the part of the public fund and for the future benefit of the future retirees. So that's my key idea, folks. Thank you for watching.